Hey everyone, great to have you with me today. I'm Sam, and I'm really excited because we're going to pull back the curtain on an investment strategy that, well, until recently, has been the domain of the world's largest financial institutions. Let me ask you something, and just, think to yourself for a moment. Have you ever heard the term private credit before? If the answer is no, you're in exactly the right place. By the end of our time together, you'll know what it is, why the smart money is pouring into it, and how you can think about it for your own portfolio. So let's dive right in. There's a quiet revolution happening in the investment world. The biggest players, I'm talking pension funds managing retirements for millions, massive insurance companies, sovereign wealth funds with fortunes larger than many countries, they are all making a deliberate shift. A shift away from that classic 60-40 stocks and bonds portfolio. Why? Well, many of you probably felt the reason in your own portfolios back in 2022. That was the year when both stocks and bonds fell off a cliff at the same time. Historically, bonds were the safe harbor when stocks got stormy. But in 2022, that safe harbor was just gone, emphatically. There was nowhere to hide. This painful experience pushed institutional investors to accelerate their move into what are called alternative investments, or alts. These are things you can't just buy on the stock exchange. We're talking assets like private equity, real estate, infrastructure, and, yes, the one we're focused on today, private credit. The growth, it's been staggering. We're talking about a market that swelled by over 60% in just a few years, hitting nearly $17 trillion by 2023, and private credit has been one of the superstars of that growth. Let me give you a concrete example, because this is where it gets real. CalPERS, that's the largest public pension fund in the United States. They manage $500 billion. And they recently decided to boost their private credit allocation to 8% of their entire fund. That's a $40 billion commitment to this space, up from, practically zero not long ago. And they're not alone. Major teachers' retirement funds and state funds are all following suit. So the big question is, why? Well, private credit is, at its heart, very simple. It's lending money to companies. But these aren't bank loans. See, following the 2008 financial crisis, new regulations made it harder for banks to make these kinds of loans. That created a massive funding gap and a huge opportunity for private lenders to step in. Think about it. If the biggest pension funds, the biggest insurance companies, even trillion-dollar sovereign wealth funds are all moving this way, shouldn't you at least understand what they're so excited about? Now, it's crucial we talk about risk. Every investment has it. If something can go up, it can also go down. So please remember, any past performance I mention is just that. It's past. It is not a predictor of the future, and all investments carry the risk of loss. But here's how these large institutions think about managing that risk. First, diversification. Spreading your money out is key, and adding an alternative like private credit can create a portfolio that's less dependent on the whims of the stock market. Second is your time horizon. Private credit is a long-term strategy. Within private credit, there's another powerful risk management tool. It's called the capital structure. I want you to picture it like a building. I'll illustrate it. At the very top, on the penthouse level, you have senior secured loans. These are the safest because in case of any trouble, they get paid back first. As you go down to the lower floors, you find riskier loans that offer higher potential returns. The higher you are in that building, the more protection you have. And this brings me to the Blue Rock High Income Institutional Credit Fund. They focus almost exclusively, about 95%, on those senior secured loans at the top of the building. They prioritize the protection of capital. On top of that, they don't just invest in one loan. The fund is diversified across more than 2,225 loans, managed by seasoned professionals at White Star Asset Management. Historically, this fund has paid distributions of around 12%. And again, while that's not a guarantee, it demonstrates a very strong track record. Imagine trying to replicate this yourself. You'd need to research, fund, and manage over 2,000 separate loans. It would be practically impossible for an individual. But through a fund like this, Alture gives you access to that institutional-grade diversification and management. And you can start with a minimum of $2,500. Now, I want to be very clear about what I'm not saying. I'm not saying you should put all your money in private credit. I'm not saying this is right for every single person. What I am saying is that if you are a long-term investor, if you are looking for income, and if you want to build a more resilient portfolio by adding true diversification, then private credit is an area you should be aware of. Now let's tackle a few of the most common questions people have. First is, how does the quarterly liquidity work? Well, this is an interval fund. It's a structure designed to balance investor liquidity with a long-term strategy. Each quarter, the fund offers to repurchase up to 5% of its shares. This provides a measure of liquidity that's, frankly, rare for this type of private investment. Second is, what happens in a downturn? Reassuringly, look, no investment is immune to a downturn. However, the fund's extreme diversification, its focus on the safest senior-level loans, and that active professional management, all of that is designed to mitigate these risks and provide resilience. And finally, how do I know if this is right for me? This really depends on your personal financial situation, your goals, your risk tolerance, your need for liquidity. For an investor seeking income who can commit capital for several years, it can be a powerful tool. I strongly encourage you, please read the fund's prospectus and speak with a financial advisor to see if it fits your specific circumstances. Now, that brings us to the end of our discussion today. Remember, this has all been for educational purposes. True diligence starts with reading the official materials. You can find everything at alterefunds.com or schedule a call with our team at alterefunds.com/contact. Thank you so much for your time. I hope this has empowered you with a new understanding of an important and growing part of the investment landscape.